I would like to begin by acknowledging the traditional owners of the land on which we are today, the Wurundjeri Woi-wurrung people of the Kulin Nation, and pay my respects to their elders, past and present. Good afternoon, everyone, and welcome. I am Leslie Martin, Associate Professor of Economics at the University of Melbourne, and I'll be moderating today's session. I have a stake in today's topic. I direct MEDAL, the Melbourne Environmental Data Analytics Lab, and I teach energy markets at the graduate level, so I'm looking forward to a good discussion. We've gathered at an interesting moment. The current oil shock is doing what energy shocks always do. It's compressing margins, squeezing household budgets, and forcing policymakers to navigate genuinely competing objectives all at once. Today's webinar, Crossroads, Australia's Economic Future After the Oil Shock, is an opportunity to think carefully about what's actually happening, what might happen next, and what structural choices can make Australia more resilient to the shocks that will inevitably follow. I'm delighted to have two excellent speakers with us today. Paul Bloxham is HSBC's Chief Economist for Australia, New Zealand, and Global Commodities. Paul spent 12 years at the Reserve Bank of Australia before joining HSBC, and his team won the AFR's award for Best Forecaster of the Australian economy and the RBA in 2024. He's also an adjunct professor at Curtin University. David Rumbens is a partner in Deloitte Access Economics macroeconomics practice, where he leads their employment and retail forecasting work and advises government and business leaders on the economic outlook, bringing particular depth on labor markets and public policy, which are both central to today's discussion. So I'm going to kick off this conversation with asking, how big is this shock really? We've seen oil price volatility before, 1973, 2008, 2022. Where does the current episode sit in historical terms? And what makes Australia's position distinctive this time?
Well, I'm happy to jump in, like from a global perspective on this particular question. The International Energy Agency put it best, really. This is the biggest shock we've seen to global oil supply in history, at least on the amount of disruption that this has caused directly. And I guess you come to this because you say, well, the Strait of Hormuz is closed. It's been closed now for almost 12 weeks come Saturday, and it typically would have about 20% of the world's oil flowing through it. And so if you take a fifth of the world's oil out of the global system in that sort of shock, it's an enormous shock to the global system. I think the thing then in that context that's surprising is how well the world has managed to absorb it so far, at least. And so we got to think about that story. So oil prices, the Brent price is up at $105 a barrel as of today. Yesterday it was 110. Now the market has moved a little bit on the expectation that maybe it'll reopen sooner, and this seems to be the daily news flow of will it or won't it reopen anytime soon. But $105 a barrel up from $60 a barrel on average in January, which was where it was. So that's still a substantial rise in oil prices, a big step up. But you might have expected to rise by even more, given 20% of the world's oil seemingly has been disrupted. The world's been much better this time round, so far at least, at absorbing this shock than we saw in the episodes through the 1970s. And a part of that reflects that there's been very high inventories around the world. I mean, if you cast back to the 70s, we didn't have the International Energy Agency and we didn't have strategic reserves in the same sort of way. So part of it is that story. Part of it is that we use a whole lot less oil to grow our global economy these days. So those two things are working at once. But if you sort of take the numbers on their face, 20% of global oil, well, that would be sort of around about 20 million barrels a day or a little bit more. It turns out that we've lost about 14 million barrels a day as a consequence of the Strait of Hormuz flowing out of the Middle East. And that's partly because the Saudis have managed to redirect quite a lot across to the Red Sea. So that's the starting point. But still, 14 million barrels a day sounds like a lot missing from the global system. But then there's lots of offsets there too. What we've done is run down strategic reserves. The US has been a big part of that. They've boosted their exports by about 4 million barrels a day relative to where they were a few months ago because they're running down strategic reserves and producing more. The Chinese are also running down their strategic reserves. So they're importing about 4 or 5 million barrels a day less than they were prior to all of this. So what have we taken off? 4, 5, that's 9, off 14. And the remaining 5 is sort of reflected in the higher oil price we've got and the demand destruction that's happened in a lot of other places where we've seen a cutback on usage. And so that sort of tries to square the circle of what we face in the sense that, yes, It has been, I think I would agree, one of the largest shock or the largest shock we've seen to global oil supply all at once. But there have been a lot more adjustment mechanisms, I think, in the global system than, say, we saw in the 70s. And that's kind of where we land. The final remark I'm going to make in this context is, of course, that means we're running down our inventories at the moment. And so we're running down these inventories so fast at the moment in the US, in China, in other places as well, that the Global Energy Agency suggests that at some point we're going to hit some point where these inventories are so low that the system starts to really not work as function as it should. And their claim is that they're running down so fast that sometime in June is about when we think we'll start to see perhaps some non-linearity showing up, where pipelines can't operate because you haven't got enough oil to keep the pressure in them, and refineries can't lower their run rates further, and they actually have to shut down. And these sorts of things that might mean there are asymmetric sort of effects or if you like, non-linearities that show up sometime in the next few weeks if we don't get the Strait of Hormuz reopened, which of course is the key uncertainty, which we all know we really can't answer right now. We will just watch and see whether it reopens at some point. So that's kind of the global context to set the scene.
So David, the June is in 10 days. Are you as optimistic about how well we have been absorbing this shock? And do you have similar concerns about what might happen if we don't reopen the strait in the within by, let's say, mid-June?
Yeah, absolutely concerned about that. So, yeah, I'm not a global commodities analyst, but like Paul, I am checking the global oil price every day because it's significant, right? So it is a major economic event, and just maybe to add to some of Paul's comments and thinking through for Australia, um, I mean, it's a bit different from the 1970s in that we are. I mean, I think as Paul said, there's greater energy efficiency. We're a bit, we're somewhat less oil dependent than we were then. Um, but against that, we're less of an oil producer in Australia. We're less of an oil refiner that we were then. And we still have some sectors that are very reliant on oil. So if we think of a lot of our transport, freight, aviation, a lot of regional activity, given that we're such a large and dispersed country, where we are very diesel reliant. The world's largest importer of diesel. So we have parts of the economy that are very significantly affected by the shock, even if we haven't. There's been those the release of reserves that's provided offset. There's been ability to I guess manage supply within Australia, but things don't get better from here if we don't open the strait. It's those offsets start to run out. I mean, it's also, I mean, if we think sort of relative to previous shocks, we're also vulnerable because we were kind of just getting into an inflationary period again anyway. So, this is a supply side inflationary shock. Um, we just, prior to this occurring, we'd already seen some interest rate rises in Australia. So we've had, already three rate rises here, which we haven't seen in other central banks around the world. So we're kind of a little bit more exposed that way anyway, because our inflation was running at a little bit higher than other comparable economies at the time. So it's coming on top of that. We know that it's kind of feeding through the supply chain. So yeah, it's a big deal, and unfortunately, some of the worst effects look like they're still coming through.
Can I add a view on that as well, just on the Australia story? I mean, the way I've been describing it, rather unfortunately, is I think we're probably the least well-prepared developed world economy right now for dealing with the nature of the shock that we face, because we've come into this negative supply shock, inflationary shock at a time when our economy is already operating beyond its full capacity and has inflation that's already too high. We've got a very weak supply side that's now getting exacerbated by a further negative supply shock. And so the RBA hasn't had much choice but to lift interest rates already. And I think they're forcing the economy at the moment into the needed downturn in demand that's going to be required to get inflation back to target. And I think today's labour force numbers, which just came out, actually, that's what kept me busy just before this call, Employment fell, the unemployment rate jumped to 4.5%, its highest level since late 2021. It's all the beginnings of the downturn that we're needing to have, it seems, to be able to get inflation back to target, given we haven't had it on target now for 4 years on a core basis, and it's about to go higher. It's a challenging spot I think Australia finds itself in.
So, so when I think oil price shock, I also think a shock in the gas market. Can you speak a little bit to that? Because although we're not big exporters of oil, we are big exporters of natural gas. And
I,
how
I
do
can
I think about the flip of that?
I can set the global scene and then maybe hand to David a little bit to talk about the domestic if he's happy with that. I can see him nodding a little bit. I mean, I think the gas story is of a similar dimension to oil in the sense that normally on a normal day, 20% of the world's liquefied natural gas would track through the Strait of Hormuz in terms of 20% of globally traded gas or on-sea traded gas. The strait is closed, so that's not functioning. I think the other element to throw into the mix for gas is there's clearly been destruction to infrastructure in the Gulf. Qatar has had its largest liquefied natural, or the world's largest liquefied natural gas plant. Las Rafan was hit by two missiles, so two of the trains of the 14 that they have been damaged in a way that won't be repaired for 3 to 5 years. At least that's the claim, and that's about 17% of the productive capacity of that particular facility. So we have a very different looking global gas market to what was the case prior to the beginning of the war. We were looking at a global gas market that was moving into a glut, a surplus, given the amount of construction that had been going on, particularly in Qatar, but in the US and Canada as well, in terms of LNG facilities. We were thinking we would have a global surplus of liquefied natural gas come 2027, and that would help contain gas prices at lowish levels, and it would help the Europeans, of course, who have sort of pivoted to being more reliant on US supply and a little bit towards the Middle East as well. We now, as a team, as a global team, are projecting that actually the global gas market will be in deficit out to 2030 because of the damage to infrastructure that's been done, and that's sort of assuming that the Strait of Hormuz at some point in time gets reopened in a way that actually heads back to something that looks a bit more like normal. So the global gas market is a whole lot more constrained. I think one other small remark that we didn't really talk about earlier in the broader remarks is, there's a very sort of differentiated effect of this shock to lots of countries in the world. The US is one of the least sort of directly impacted by all of this because they've got their net energy exporters. They produce gas. The Henry Hub price of gas, the onshore price of gas in the US has actually fallen since the beginning of the year. It's lower than it was at the beginning of the year, which is kind of stunning when you think about it. They're still affected by oil markets. Gasoline prices have gone up sharply, as you probably all can understand. But the US story is fairly well insulated. Europe is fairly hard hit because they're reliant on imported energy, and that's squeezing household budgets and businesses already to some degree. And then, of course, Asia is the bit that is most exposed because 85% of the gas, 85% of the oil, roughly the same numbers that come through the strait on a normal day are on their way to the Asian economies. And I guess we're talking about oil only here, but I write a lot about all of the commodities. So oil, gas. 35% of the world's fertilizer comes from the Middle East. 25% of the world's sulfur comes from the Middle East. 30% of the world's helium. Almost 10% of the world's aluminium. So there are a whole collection of things that are supply chain disrupted at the moment that are key critical inputs into growing our global economy. And in particular, those things are typically on their way through the Strait of Hormuz to Asia. So Asia is the most exposed more generally, but gas. Yes, big effect. And then on net, I guess there's some positives for Australia in the sense of higher gas prices, but I'll leave that for David to talk a bit about.
Yeah, look, it's a good point. So I mean, Australia's a net energy exporter, so there should be a channel there that's while there's a significant hit to consumers from petrol prices, that we get some benefit from gas exports. And we do expect to see this, but it might be with a bit of a lag because a lot of our LNG is sold on contracts. A lot of those are linked to the price of crude oil. So as that price goes up, then there will be some gain in those prices, but it may take a little while to come through. But it is generally a factor as to why, say, like the federal budget is in a potentially a healthier position from a shock which probably lifts Australia's terms of trade by a little bit, and is broadly inflationary as well. So if we think of there's redistributive effects of the oil price shock. I mean, it's generally away from consumers, towards energy exporters. The federal government may get some dividend from that. Um, Within consumers, though, it's tricky. I mean, it's a regressive shock. It's going to hit those on lower incomes, by more. Those who are more reliant on using fuel. It's likely to hit those in regional areas to a greater extent as well, more fuel dependent. Um, so there's while within the country there might be overall you know, somewhat national income balance eventually out of the shock. There is a lot of redistribution that kind of needs to be managed.
Paul, you talked a little bit about the effects on the Asian market of gas, but then also all of these other products. Are you more concerned about the direct impacts of oil and gas prices on the Australian economy, or the secondary ones that come from the fact that our economy is so linked to the Asian market and to demand for our products coming from there?
I would say I'm concerned about both. The larger part of this shock is likely to be, and again, a lot of it depends how long the Strait of Hormuz is closed. But the longer it goes on, the more damage it's likely to do, and the bigger element of that shock is going to show up in Asia, which is obviously the large collection of our major trading partners. So I guess then you look a little deeper and say which parts of Asia, and the story is, well, Japan relies on imports of oil from the Middle East for about 90% of what it uses, so it's pretty exposed. Korea, it's about 70%, so it's exposed. The smaller Asian economies, I guess, inverted commas, smaller places like Indonesia, Thailand, Vietnam are pretty heavily exposed. And then the even smaller ones, sort of Bangladesh, Sri Lanka, Pakistan, they're all quite exposed. Now, China, being obviously our biggest trading partner and the biggest country in the region and the fastest, the one that we need to focus on a fair bit, China's in a little bit of a different spot because they've got very high strategic reserves across a range of different commodities. But I still think they're vulnerable. They've got 100 days of oil on, at least they did when we started this episode off. So that's a story that will help them. But they are reliant still. About 50% of their oil typically comes from the Middle East. Now, some of that's still getting through, actually. The Iranians are still exporting some of their product. The product that they are getting out is getting over to getting to China. And then India. I guess India is also reasonably heavily exposed to all of this because they're not only an importer of energy and oil, which is a big feature of the story, but they're also susceptible to the fertilizer story. And I think probably more so than certainly than some others. And so, the Asia story itself, it looks as though there's a fair bit of downside risk to this, and that's could flow through to Australia, as you say, indirectly. And then the direct impact on Australia, well, part of it's been cushioned by the fact that the government's cut excise, so we haven't all faced the high petrol prices in their entirety. But I think what you have seen is some of the other downstream products, like, we talk about oil in the context of petrol, but oil is used to produce jet fuel. It's used to produce naphtha, which goes into the production of plastics. It's used to produce bunker fuel and gas oil, which are used for shipping. For all of those products, those refined products, actually the price has gone up even more than the oil price. Run rates have slowed down in terms of the refineries producing those products, and they're all having an impact on the cost base for businesses. And in some cases, you're seeing businesses actually, well, because the economy has been operating beyond its capacity of late, they've been passing on or trying to pass on those cost-based rises quite quickly to their final prices, which is, of course, contributing to the inflation as well. So we're obviously vulnerable. I guess there's an outstanding vulnerability of potentially our diesel supplies, our onshore supplies of fuel are very, very low relative to other countries, and I guess they're shoring that up by finding agreements and more of the product to come our way. But in terms of the prices, we've already seen the prices of a lot of these inputs rise, and I think it's already lifting producer prices. So that's the way I think the primary transmission mechanism into an economy that's already got too much inflation, and one where the RBA is already responding to that by lifting interest rates 3 times. So I think that's what, if you put it all together, you've got an economy that's got a pretty hefty supply side challenge that's going to need the economy to slow down to deal with it.
So thinking about this heterogeneous impact of inflation across the Australian economy, and this question for David, um, if I'm thinking logistics, manufacturing, retail, individual industries, where are you anticipating the largest impacts on inflation? And what does that say in terms of what types of policies we should be thinking of now, above and beyond, for instance, having a counter-cyclical petrol excise tax?
Yeah, well, look, it's. I mean, I think Paul's started to map that out as to where it's going to impact. So the larger users of fuel and fertilizer, so transport sector, agriculture, manufacturing, construction, are seeing their cost base come through, and then that's getting passed on or starting to get passed on to other sectors like retail in particular. I mean, it's those goods where transport takes up a higher share of the product. I think bulkier commodities like bread, for example, for retailers, lower value. There's a lot of transport embedded in the production of bread, and so there's going to be little offset to retailers having to put up those prices. So that's what we'll start to see as the kind of secondary chain of price effects come through. We saw in March, some of the direct effects, but we know those secondary elements are coming through. In terms of policy as well. I mean, we've seen, fuel security as a key policy. So as much as possible, shoring up supply so that we are dealing with a pricing problem rather than an actual shortage problem. And given that Australia is a comparatively rich country, then that's what we'd expect to largely be the consequence for us. We will pay the higher price generally rather than miss out is kind of the likely prognosis. Um, but then offsets to those that are most affected. So we've seen the fuel excise cut. We've seen free public transport in Victoria as an offset. But these are expensive policies. So these are things that you could consider as a short. Well, if we think it's a short shock, then it's income support for those that are affected, noting that it doesn't make the RBA's job any easier. Um, but if it becomes protracted, how long are we going to keep those policies in place? Because we know that they're quite expensive. So there'll be a decision for the federal government coming up. I mean, they've chosen in the budget not to extend the fuel excise cut, but then there's been conversation afterwards that, well, no, that's still under consideration, and we'll see how things go up until June. But we know that it's quite an expensive budget item. So those shorter term income supports are really at play while we look at trying to shore up supplies and build supply capacity.
So we have a great question from the audience that instead of focusing as much on policies, structural reforms, right? So if you had to nominate one structural reform that would do the most to reduce, and I'm reading their question here, Australia's vulnerability to the next oil or commodity shock, not manage this one, what would it be and why hasn't it happened yet? Could I first pass this by Paul, and then I'd also be keen to hear, David, what you think?
Well, I think what we've learned from this and what the government has already announced actually is a policy to seek to try and shore up more onshore supply for these sorts of events. If you do a global comparison, and we do a lot of this at HSBC, and you rank all these different countries in terms of the amount of oil and refined products that they've got in storage onshore, we are both, by the way, Australia and New Zealand are at the bottom end of all of the charts in terms of the amount that we've got onshore stored. So I think that's something that potentially, well, and there's already action in place, policy measures in place to try and deal with that. I mean, there's a question to be asked about whether we should actually have a bit more refining capacity onshore as well. I haven't got a really strong view on that, but I think certainly holding more inventories makes sense in the face of these sorts of supply shocks. And that's a general rule for all of these answers, all of these questions, isn't it? We had a pandemic, the COVID pandemic, and what we learned was that just-in-time systems are great for efficiency, but they're not really great for protecting yourself against when supply chains break down. And so you have to balance the just in time versus the just in case. And the answer to that is to hold a bit more inventory. It costs you something. You're losing some efficiency, and you're buying some insurance against negative possibilities. But when you are in a world where there are likely to be more frequent negative supply shocks to supply chains, then that insurance pays off when those shocks arrive.
I feel like strategic reserves are doing a lot of heavy lifting in this conversation, that it's the reason that we've absorbed it relatively well and it's the solution for moving forward. Is there not something more structural going on though? If these shocks are things that, so like, what do we have? We started off where we had what, a month worth of reserves, and now we're talking about, let's say we'll go like China and have 100 days worth of reserves. Is that really solving the structural issue, or is that just
The other way this is going to come about, which I think is a great little conversation turn as well, but I'm going to stop. I'm going to hand over to David in a moment, but is that this will accelerate countries in terms of their sort of looking more harder at energy security, and it puts a lot of focus on the energy transition, making the energy transition faster, having reliable sources of energy that don't rely on imported fossil fuels from unstable regions. I mean, that will, I think, accelerate the energy transition in principle. It should, at least. We should be looking to build more renewables capacity, and that can be delivered onshore, and then you can rely on that more and pivoting more to electricity as a key source rather than fossil fuel. So that's one that I think it will happen. The price mechanism's there for it to happen, right? The oil price is $110 or $105 a barrel. That just makes it even more competitive if it's a sustained higher cost of fossil fuels in the future, to then pivot into building more solar farms, wind farms, and building more battery backup capacity and electrifying more quickly.
so you see electric vehicles as the structural solution here?
I see them as the likely outcome of the price mechanism at work. The price mechanism does work when the price of solar panels is falling dramatically and has done and continue to do, batteries too, and the economics of the electric, the sort of the renewable story works so much better, relative to the fossil fuel prices when they're even higher. So yes, I think economics works. This is always a great thing to say on these sorts of economic society calls. And relative prices will shift behavior in a way that actually encourages a structural shift that's already underway, but will likely get accelerated by these sorts of events.
Well, as long as we're not running
Yeah.
them off of coal. David.
Well, yeah, I was going to go down that track as well because for the question, I mean, in part we have partly prepared ourselves better than say the 1970s. I mean, we are less oil dependent than we were. We are more efficient energy users than we were, and at least in electricity supply, we're some way down the track of having a high share of renewables. So we have done some of that prep work. Doesn't mean that it's still not affecting us now, but that is, I think, in part the answer, going forward, having a greater diversity of energy sources and indeed, yeah, greater use of electric vehicles in the transport task. Maybe just another kind of aspect, and this is not specific to fuel, but it's more just the macro settings. And I think Paul and I both noted at the start. I mean, this shock hit when inflation was already taking off in Australia because of kind of supply constraints, and so that's why so far it's well, the RBA is the major central bank that's been lifting rates when others haven't. Not that they won't, but we're off the mark first. So. And in part that's because our supply capacity hasn't been strong. So all the things that we talk about in terms of raising productivity growth and having a stronger supply capacity in a general sense are important too. As is having some fiscal capacity for a rainy day, for when a shock hits, so that okay, if we need to do countercyclical moves by government to support the economy, we're in a position where we can do that. And arguably, we can at the federal level. That there's a healthy enough federal budget that if we really needed to significantly support parts of the economy, that we could. But at the state level, we don't have that much capacity. Particularly thinking in Victoria, we're kind of really up against it in terms of already running a high level of debt, having a high interest burden, and so we see the Victorian government responds with free public transport, but that's only going to be a limited ability to respond along those sort of lines. So those kind of macro settings are important as well, I think.
Is counter-cyclicality easier for us because we have export revenues that are so tied to these energy markets as well?
Yeah, I mean, we're seeing some dividend to the federal government, and there's been the and continues the discussion around, should we have higher taxes on gas exports um, to be able to accrue, more revenue from that trade that then can be shared around to the community. But there are already taxes anyway. So just putting the merits of that aside, I mean, there are tax collections through company tax and PRRT that will come through anyway, at least to some extent. Um, so yes, I think there is, a legitimate role for government to, share the burden of these sort of events, by, and particularly as it is, somewhat regressive um, price increase as well, hitting those on lower incomes harder. Um,
I feel
the
like Paul wants to jump in here. Can we
Yeah,
Awesome.
yeah.
jump
Jump
I
in a
in.
just
quick?
I think that's all really true, but I also think that we're in the nature of the shock we face right now is quite different to like a negative demand shocks we faced in the past. When COVID came along, we got a negative demand shock. Yes, we got supply disruptions, but primarily what happened was we were all told we couldn't do all the things we wanted to do. Demand fell sharply, and governments could step up and support things. When the global financial crisis came along, it was a huge negative demand shock to the global system, flowed through to us too. And so it made sense for governments to step up and spend more and the RBA to cut interest rates and so on. We are in a supply constrained economy already, as we both agree, where inflation's already too high and we're getting another negative supply shock on top of that. And so governments have to be super careful not to pump prime demand, because if they pump prime demand, they just create more inflation. The policy choices right now are so much more limited and need to be so much more nuanced, because it really is, as you say, David, and I agree with this element, about redistributing from one group to another, but not pump priming the overall macro economy. Because if you pump prime the macro economy, you get more inflation, and therefore the RBA has to take it back with higher interest rates. That's not optimal policy. The optimal policy pathway is to wholly focus on the supply side and find reforms that you can do to allow the economy to have more capacity to deliver. So speed up the energy transition, speed up the housing supply story, make the economy more efficient, make labor supply more efficient. These are the sorts of things. And I guess they're just very difficult to do, and they take time as well. So you've got to plan to do it now so that it pays off somewhere down the track. I see the current challenge as one that's really quite difficult to manage, because the policy choices are so limited, and it's quite a difficult spot to be in when you're dealing with a negative supply shock on top of a supply constrained economy.
Um, so I feel like we've talked about the short term where we're protected by these buffer stocks, and the long term where we'll be in a world with lots of electric vehicles. But right now, my understanding is last month we had the highest record ever of EV adoption. It was 16% of all new vehicles, but we still have less than 2% of the total fleet of vehicles on the road that are electric vehicles, right? So what happens in this middle period? So if the shock lasts for, let's say, another 4 to 6 months, we won't have the EVs yet. What happens to the Australian economy then? What are the best case, worst case scenarios? How do you see that? How do you see that panning out? Let's say 6 months from now, 18 months from now.
Can I jump in and say my central case? My central case is Australia has an economic downturn, and it needs to have an economic downturn. We have GDP contracting in the short run, so literally contracting. I mean, we haven't gone quite as far as putting 2 consecutive quarters of negative GDP in, but that's a risk. And the economy needs to slow down to well below its speed limit, and its speed limit at the moment is low. We think it's probably, the RBA thinks it's 2%. We think it's probably closer to 1.8, and we've got to slow down to below that. So we see growth slowing down to 1% this year, and still remaining at sort of sub 1.5 into next year as we seek to get inflation down. That drives the unemployment rate up to, on our central case, 5% by the middle of next year. We jumped to 4.5 just today. And so that's what we face. We face an economy that's in a downturn because we need to weaken demand in order to get it to operate below its speed limit to be able to disinflate. And the best fix, the best thing you can do is take action now that pays off somewhere down the track, as you say, that improves the supply side of the economy, pivots the energy transition more quickly, makes the economy more flexible, lifts productivity in the medium term. Unfortunately, I'm not completely convinced, or I'm certainly not convinced that there was that much of that, in the budget. I think the budget was an opportunity to do a lot of this stuff. And in the end, it didn't touch on a lot of it. I think that's where we're missing an opportunity at the moment to really try and reframe the supply side of the economy to make it more to allow productivity growth to run faster in 2 years' time from now. Not You can't get it to happen immediately, but in 2 years' time from now, we want it to be running faster so that we're not still running at 1.5% growth in 2 years' time, which is what the RBA, I might add, is forecasting. That is their forecast, that we're at 1.5% growth still in 2 years' time from now, which I think is, quite disappointing if we can't get the supply side to improve a lot more by then.
David, do you agree with Paul's central case scenario? And if we have this GDP downturn, who's going to
Yeah.
bear the cost of that?
Yeah, I think, I mean, the longer this goes on, it's hard to avoid a GDP downturn. I mean, Paul's reported the labour force stats from today, and so, arguably we're starting to see it. We're starting to see it in some of the consumption data. Um, you know, Governments can do some things to offset it. Individual consumers and businesses can do things to offset it by their spending and saving behaviour, but a downturn is very likely. Well, is basically underway, and I think we'll see. I mean, the disruption may go on for more than a few months, as you painted out. I mean, it may go on into next year and the following year as well. We don't know how it's all going to unfold. The worst of the pain is probably likely to be in this first year, though, in 2026, because over time, we start to get some, potentially other supply responses and demand adjustment coming through. But as with all supply factors, that does take some time to happen. In terms of, I mean, it's interesting dilemma then for the Reserve Bank as to how they consider it, because they've got a dual mandate, right? So they've interested in supporting full employment and the success of the economy as well. So at what point do they say, well, there's an inflation problem, but we also have an employment problem as well, and kind of pivot to that. It's a lot of that goes through to the secondary price effects. I mean, we hear a lot from the Reserve Bank about feeding through into inflation expectations and pricing behaviour and wage increases as well. This is the danger for the economy of this perpetuating, is that the supply inflation shock, yes, feeds through to higher prices, which feeds to high wages, and we get an ongoing cycle that can only really be resolved by kind of the heavy hand of the Reserve Bank coming down and taking demand out. If we have a way to kind of limit to some extent those businesses putting up prices or workers bidding for higher wages, then that puts us in a better stead to kind of get through this as a temporary phase rather than an ongoing inflation cycle. And so what can you do to encourage that? Well, you can encourage greater competition. And so that's, there's pressure on businesses in some cases not to put up prices, to perhaps absorb some of the price increase, or to go smarter, to be more efficient, to invest in more efficient processes that don't put up prices, and similarly a competitive labour market so that wages don't get bid up so much. So encouraging those sort of things can help, I think, at the margin in reducing the ability of the one-off supply shock to then become embedded in inflation, and therefore maybe allow the Reserve Bank to go a bit easier than they otherwise might.
So, David, I'd like you to be a little bit more specific what you have in mind when you say encourage competition, both for firms and for within the labor market. Like, what type of policies do you have in mind here?
Well, I mean, I think, yeah, I mean, looking at I mean, it's almost kind of like sector by sector. So, looking at barriers to entry in particular sectors, are there, what is the degree of competition across particular sectors? Are there things that are stopping people investing um, or coming into particular sectors? Are we discouraging use of technology, for example, that might, through regulation? Part of this is a regulatory effort. I think on the Labor side, we've seen some of that in in the reforms in the budget as well, looking at occupational licensing as a way to encourage mobility of labour between regions and between states. So I think there's some merit in the um, deregulation or reform of regulation agenda that could encourage greater mobility of labour and um, reduced impost on businesses that might encourage more competition as well.
Paul, do you have one of the questions that we received were, well, we have a few questions in the line of, please give us some specific policies. What do you think what policies do you have in mind other than having larger strategic reserves that could lead us to mitigate the negative impacts of potential downturns, make the labor sector, like the labor market more competitive, the firms more competitive, etc.?
Yeah, so I mean, this is a constant for me in terms of, our single biggest challenge in Australia is that productivity growth has been very poor. We've had one of the worst productivity performances of any of the developed world economies in the post-pandemic period. The last readings of productivity up to date, you'd say the average over the past decade is 0.3% a year. And then you'd compare that to, the previous decade, the one that ended a decade ago, up to 2016, where we used to run at 1.2 on average. So we've got a big productivity problem. And to me, that's the fundamental issue. So how do you deal with this? Well, I agree with David and a few of his remarks around we need more competition in the economy, and we ought to focus on that. Barriers to entry are a feature of this story. I guess if I had to put a list together, the starting point would be I think we should start with tax reform. We clearly need more tax revenue given the commitments the government's making to do more spending. And so, in order to do that, you want to make the tax system more efficient than it is. It's highly inefficient. It's becoming more and more inefficient as time goes by. I tell this story of if you rank all of the OECD economies, 38 of them on a chart, and you look at the proportion of the income that the government gets from the most inefficient taxes, the personal income tax system and the corporate tax system, Australia is second from the top in terms of those 38 countries. Obviously, high personal income tax rates discourage participation in the labour market. High corporate tax rates discourage investment and innovation by firms, and so you want to not be as reliant on these types of taxes, but we are highly reliant on them. And if you did the same ranking of those 38 countries and you looked at the GST, which is our broadest, probably most efficient tax at a federal level, certainly one of the most efficient ones, we're fourth from the bottom because we've got a low GST rate and a low coverage in terms of because of the exclusions that were put in at the beginning. So I think of the sort of tax reform agenda as really being about lowering personal income tax rates, lowering the business tax rate, corporate tax rate, and offsetting it by finding a way to lift and broaden the base of the GST. And I think that would be a good start. There'd be many other things you can do, but make the tax system more efficient, make it encourage the things we need to grow our economy, labour market participation and investment and innovation by firms. I guess second on my list is the regulatory environment. When I talk to firms, and my job is to really be client facing, so I talk to institutional investors and I talk to businesses most days. And if I say to them, and I do this on a regular basis, what are the main things that are constraining you from making that next investment decision or that next expansion plan or that next innovative step? And, primarily the feedback I get is the regulatory environment is so complicated and it's very difficult to get the workers that I need and to get them to do what I want them to do. So in that vein, I'd say look at the regulatory environment and see if we can streamline it even more. Look at the industrial relations system and move it in a direction that actually means that it's easier to get workers and to get workers to do the things that businesses want. If we want businesses to be able to get over their hurdle rates, to commit to making investment decisions and innovate, and those are the sorts of things that would contribute to more productivity growth, then we have to kind of make it a little bit easier and to get there. So those are the sort of two big ones for me. I mean, there's a lot of detail that you can go into beyond that, but tax reform and looking at the regulatory environment, these would be on next, and then after that, it would be competition policy, in my sort of list of things that I would think we ought to really, really focus on. And I guess I look at what happened in the budget and I say we didn't really tackle those things in the scale that I think we really need to, is a fair, if that's a fair way to put it, given the nature, the scale, and given the size of the challenge we face, where productivity growth is anemic, and we want to encourage businesses to invest and innovate, and it's not clear that policy shifts actually do that. If anything, actually, there's some policy shifts that were made that look as though they may even discourage that, around the capital gains tax arrangements that have been announced.
Do you have any concerns about the potential distributional impacts of the tax reform policies that you are proposing, especially in the context of there being high energy prices, which typically do in themselves affect lower income budgets more intensely?
We absolutely need to take distributional consequences into account. And when you do these steps, you find a way to make sure you support the lower end of the income distribution. There's no reason why you shouldn't be able to do that. If you lift the GST, in fact, when we introduced the GST in the year 2000, 26 years ago, we overcompensated the bottom end of the income distribution in order to try and get that tax change over the line. And I would imagine that that's exactly what you find a way to do. So when you're lifting one tax, you're lowering another, but you're finding ways along the way to make sure the distribution is protected. The bottom end of the distribution is protected by those changes. I think that's absolutely what you can do, in a broad-based way. I guess the main point that I'm really driving at is redistributing is very important, but growing the pie, it should be given equal status, because actually we need more so that we have more pie to share around. It's not going to be easy if the task is, if we don't get to grow the economy very much at all, to then just constantly redistribute. So there needs to be more focus on productivity enhancing reform. We need to be, to have a speed limit on our economy right now, which is sort of the RBA saying 2%, I would say is more like 1.8. But to say it's that low is really terribly disappointing when you think about it hard. That we've basically got per capita GDP that's doing nothing, and has done for a run of years. We need to aspire at least to lift productivity to be able to grow the pie more before, so we've got more pie to distribute around.
David, do you agree with Paul?
Oh, yeah, absolutely. It's both are important. Lifting the overall rate of economic growth and how we distribute it, and yeah, it is, I think, false thinking just to focus on redistribution. But the other thing though about productivity is, I mean, there's rightly quite a focus, and particularly in this context, on what the government can do. I mean, most productivity growth is essentially coming from the business sector, from technology development, technology implementation, business process change. We've there's a big change happening at the moment in terms of AI investment, and we are, while energy prices might be the energy shock might be the story of 2026. I suspect the economic story of the 2020s will be all about AI and how we manage that change, and whether we get actually the best benefits to the economy from that change, and how we manage that change through the workforce, and also protection of privacy and legal rights and so on. I mean, there's a lot underway there that we have to manage. I think the evidence is mixed, but increasingly it seems apparent that we are getting productivity dividends from AI in other countries, in the US, where it's perhaps not so apparent that we're getting it here yet, but that would kind of make some sense, and that other countries are kind of ahead on the AI curve.
What is
But
missing
there's
from our AI policy, our set of AI policies, to the extent that we have explicit AI policies?
Well, I mean, I think it's all about setting a good framework for AI investment, and in part, a lot of the development is taking place in the US and in China and elsewhere, and it's not necessarily a bad strategy for Australia to be somewhat of a fast follower in that respect, and seeing what's happening elsewhere and understanding what works and getting on board with that as long. But that will be supported by, I guess, a good regulatory framework which supports that, but also allows. I mean, it's not all government policy; it's business choices as well. I mean, it's businesses choosing as to to what extent they are going to be using AI tools and how strategically they think about it. And from what we see, I mean, there's across the business sector, there's a lot of interest in AI. There's a lot of investment in AI, ranging from kind of small scale personal productivity stuff to sort of larger scale process changes. Those businesses that are going into AI more fulsomely in terms of process changes are the ones that so far that are most likely to say it's been a big success for them. So there's a bit of affirmation coming through. It's so we I guess the point is there is a potentially a productivity enhancing tool or set of tools that is have can have a transformative effect on our economy, and how we manage that, both to enable that growth, but also to have sensible protections, including for workers, and sensible transition along the way, I think is going to be really, really important over the next few years.
There's a nice question that is in the feed that I wanted to give to Paul, if you don't mind not jumping in just yet on that one. What are the best sources of information we should be consulting to assess if there are coming supply shocks to Australia? Refining in Singapore? Ships en route? What are the warning signals that suggest that pain is coming?
Oh, great question. So we are at least, and I think that's in the context of the current shock is what we're presumably talking about, and certainly I'll refer to that. I think those are those sorts of things we're watching. I mean, I think the other things we're watching are things like refinery rates in Asia at the moment. So, the last ships that came out of the Strait of Hormuz arrived at their destination about 3 weeks ago, almost 4 weeks ago. And so feedstock is starting to get more limited in Asia for the refineries. The refineries have been lowering their run rates. They don't want to stop them altogether because that's actually a really big exercise. But if you can run at a lower rate for a period of time, that's how you deal with this. And then you watch then the sort of output prices that come off the back of that. So Singapore jet fuel prices are still at very high levels. They've come down a bit, but that's something to watch, I guess, in terms of an input. I mean, tracking, we track the ships to the extent that there are some coming through. I think the news flow this morning was that there were 3 or 4 ships that actually got through the Strait of Hormuz, mostly on their way to China, and I think there was one on its way to Korea. So these are the sorts of tracking indicators where for the broader story. And then I guess specifically for Australia, I mean, it's more about the sort of how many reserves have we got, how many ships of diesel have arrived, how many are getting here, and so on. I think I mean, we're sort of trying to keep track of all of those various things. It's not, it's an interesting environment at the moment because we're not, as a macroeconomist, there's sort of some standard things you normally track, like you'd normally track the Brent crude oil price. In fact, I watch it all the time still, but actually it's not telling you the full story right now. If you want the full story, you've got to look at things like the refined product prices, because the crack spreads between the group crude price and those refined products have blown out. So they're at very high levels. So jet fuel prices matter, and gas oil prices matter, and bunker fuel and naphtha prices, they're all tracking in their own sort of way because of the supply disruptions that you face. And so summing all that together is not very easy because you're normally used to tracking these sort of primary indicators that you always watch, but that means you're then down in the granular for keeping track of what's going on in terms of those supply chain disruptions. And that's just really the oil offtake story, because you've got to then get into, we've written a little bit about fertilizer and how do we track that, and the different types of fertilizer and what's going on with the input prices. Sulfur, one that I hadn't really thought about at all until this story came along, and we discovered, or we knew at least, or we really got into the detail around 25% of the world's sulfur comes from the Middle East. Turns out sulfur is a key input into the production of fertilizer, semiconductors, and processing of copper and nickel. And, China at the beginning of May put a ban on exports of sulfuric acid because they want to contain the sulfur for themselves, maintain it for themselves to produce fertilizer, which of course forces the price up of processing, or the forces up the price of available sulfuric acid supplies for places like Chile and Indonesia that use a lot of it to process nickel and copper. So we're in a lot of the granular detail trying to work out how we map this episode, which is obviously quite unique, to some of the macro indicators.
So, a lot of businesses in the audience are making investments and hiring decisions under genuine uncertainty. If you had to give them one piece of practical advice about positioning for the next 2 years, what would it be?
I'm happy to jump in first, if that's all right with David. I mean, my view is this. The Australian economy is going to go, it has to have a downturn. And that's like an unfortunate reality, but it's really the truth that demand needs to weaken in order to get inflation back to target. Now, it'll weaken in one of two ways. One, the RBA may have to lift interest rates further and force it into a downturn. Maybe not. Maybe the global story, which we've talked about so much in so much detail, cascades into the weakness that feeds through to the local story. And that's how we get the downturn. But if the takeaway from this is, we're going to have a downturn in demand, because how else do you get inflation down? So gear up for that. And so as a business, what is happening right now, and you can see it actually in the surveys, and certainly I get it anecdotally as well, has been, as fast as you can, try to sort of lift your prices because you're facing higher costs, and do that while demand's actually holding up reasonably well. But if demand's about to weaken, that's what's coming over the next little while, you're going to get a margin squeeze unless you pivot, and you pivot into the typical thing, which is cost. You focus on your cost base and you start trying to contain your cost base. And this is where I think it gets really interesting, because what you do, your immediate will be to focus on the short-term cost-based story. But actually the primary thing you can connect, the two bits you can connect together are, I need to get my cost base down, but I need to improve my efficiency as well. I need to improve my productivity. And at the same time, most businesses have got an agenda to try and adopt AI. So I think you combine the two. I've got to focus on my cost base, improve my efficiencies, apply AI maybe more rapidly than I thought previously, to find a way to keep my cost basically growing more slowly, in the face of the margin squeeze that I've got from the negative supply shock that's come from abroad. That's what I would say you do. So you structure this around, I got to get my cost base down, but it's not really about today or tomorrow or this month. It's about, in 2 years' time, having a more dynamic business that actually has integrated AI and found a way to improve my efficiencies. Because I've got to do that, because I've got to get my costs down now, and I've got to do that and I should do that because that's going to improve the way I operate in a medium-term sense.
David, do you have anything
Yeah,
to add to this question? It's going to be our last, because we're going to have to wrap up, unfortunately.
yeah. No, thanks, Leslie. Yeah, I mean, I think what we're seeing with business, and indeed, yeah, I mean, one of the surveys that Deloitte conducts, a lot of negativity about the economic environment, but then businesses saying, "Oh no, we think we'll be okay." Like, the confidence in own performance has just gone down a little bit compared to confidence in the broader economy, which has gone down a lot. So there is a bit of confidence in, well, maybe not so much in exactly what the business is doing, but maybe, some of the things that Paul was outlining there in terms of, okay, well, yeah, we can do cost cutting, we can look at supply chains and rationalize. I mean, one thing that I would say, is prudent, and maybe this is sort of talking my own book as a macroeconomist who talks to business people, is the benefit of scenario analysis and scenario planning, particularly at a time like this when we have an external event that we've got, there's no control over. But it is, it could be very significant in the broader economy and own business performance over the next few years. So doing that sort of scenario analysis, working out, well, what areas of my business are, relatively more resilient, and which ones, might find it tougher. What areas of potential future capital investment are affected by this? Which other ones do we need to actually prioritize and keep doing? I think can be, and whether that's on, okay, the conflict ends in a month, or we end up with, $150 oil price through the year, or something like Federal Treasury put into their scenario. They went up to $200 oil price, but then it came off very quickly. So there's a few different things that can be tested out as to whether, does that affect businesses, capital and workforce decisions?
Well, Thank you both, and thank you to everyone who joined us and submitted such good questions. We covered a lot of ground today, from the pressures on households and businesses, the role of strategic reserves, competition policy, and how stocks transmit through the economy, to the very real risk of a broader downturn and what that will imply for Australia. I hope this leaves you with a clearer sense of the terrain. And again, thank you very much to our two speakers today. This was a really interesting conversation for me.
Thanks, Leslie. Thanks, David.
Thanks all.